Welcome back, investors, to Ticker Time News. I'm Adam, and SoFi, a fintech company, is in the middle of an epic short squeeze. But there's one thing that not too people are talking about right now with all the hype surrounding SoFi, and including the FOMO, the fear of missing out. It's real. Now, honestly, what should you do? What should you do now that SoFi is up huge? It was up 28% today. And actually, if we go and measure this, let's look at this from earnings, right? Where it lifted off from earnings. If we go down here, about $6.30, all the way up to the peak that it hit today is about a 34.4% gain in 2 days. If that's not a short squeeze, I don't know what is. 34% in 2 days? Yeah. So what should you do? Honestly, ride it higher. Ride this short squeeze for all it's got. But you'd be a fool not to take some profit off the table right now as the squeeze continues. See, SoFi being up 28.3% today, just today, it's now down 1.2% here in the after hours. So one strategy is to sell enough to get your initial investment back. If you bought SoFi going into earnings as a trade or a swing trade, take what you put in off the table and then let the rest of it ride for as long as this short squeeze can continue. That's the best advice that I have. Although this is not financial advice. Reporting for duty. Awesome. Glad to see you here. Totally. Okay. Short squeeze for SoFi. I have this gray boxed area for SoFi here on the chart. Why? Because this is going to be a very sticky spot. For those who think that SoFi could just go to the moon from here, I hate to bust your bubble, excuse me, but this line, it's like a line in the sand. And you can see that, well, maybe not. Today's wick did break above the top area of this zone, but it came back to close right back in this zone today. And that's because if we go back to these two yellow circles on the chart, May 20th and further back to March 14th, these were significant areas. First, March 14th, it was the last real support that SoFi had on this long journey down from, what was this thing, nearly $30 over a year and a half ago? Then the second one in May, that acted as resistance. So old support became new resistance, right? That always happens with technical analysis. It's like some magical thing that happens. Well, that resistance is being tested right now, and it failed. If this short squeeze for SoFi is going to continue, and yeah, go SoFi, finally, right? Wow, what a ride. If SoFi is going to move any higher than where it's at right now, it's going to need to close above this zone. So let's call it, let's get this out here. Let's call this top of the zone right where it is right now. Let's say $8.23, where it closed today. Tomorrow, to get this thing going, it needs to extend past this point and then close above this point for this to be any type of bullish move outside of just a typical short squeeze. And with short squeezes, they go up, and just as quickly they come down. So just be careful with that on the back end of this trade. It could quickly wipe out and fall back into the zone that it was in, back down here in the $6 to $7 range. So just be careful of that. I am awfully glad that SoFi is running. I love the company long term. I am a long-term holder of SoFi. I bought SoFi, back when it was $24 a share. I still have some of those, so my cost basis isn't as low as these $6 to $7 that SoFi has hit. Maybe even close. What is the 52-week low? $5 and something. Let me go look. $4.82. Yeah, I wish my cost basis was that low for SoFi. If you got in that low, congratulations. You're holding on to a great company. And if you're trading the short squeeze, well, awesome for you too, because you're doing good on that one as well. Just be careful on the back end of this. Like I said earlier, just a few moments ago, as quickly as it goes up, the balloon can burst, the short squeeze can be over, and down it comes. Now, one thing to know about short squeezes, they're not a one squeeze and it's done, right? A company can have multiple short squeezes. This is my belief. When a company goes through a short squeeze, it's because people are shorting the company, thinking that the stock is going to go down further, and then people go and start buying because of good news, maybe off of great earnings like SoFi just had, big user growth. That was a plus on SoFi's earnings. And then those who were shorting it, well, guess what? They may want to close out and not get completely wiped out. And that just helps the stock to go up even further. So a lot of pressure here on SoFi to maintain this if it can. But if not, when it comes back down, guess what those who think the stock will continue to fall will do? They will short the company. And that in itself can create a second, a third, a fourth, a fifth short squeeze for a company stock. Now, it may not happen, week after week after week. It may be 6 months before another short squeeze happens. Time will tell, right? But long term, I think SoFi is a wonderful company. After we get out of this bear market and we get back into a bull market, SoFi is definitely a company. I think, at least I'm putting my money where my mouth is on this one to own for the long term, like a decade plus. That's how much I believe in this company. All right, let's talk about the rest of the stock market today. It had a distinctively strong showing. Let me pull up the SPX for the S&P 500. Today, the market recouped any of this week's earlier losses. The initial factors affecting sentiment were falling oil prices, better than expected earnings news, and some good economic data, and a measure of relief that, of course, Speaker Nancy Pelosi's visit to Taiwan didn't provoke something negative from China. I know China is circling around Taiwan and flexing its muscles there, but at least for now, tensions are a little bit hotter, but the market never did price in any particular fear about this trip to Taiwan. So now everything's good. The market rallied. A lot of it came from that news. And of course, the market is a bit short with people buying puts against the market, right? And that helps the market to go up too. The more it rides, the more it goes up, the more those shorts, they've got to get out of their position. So that helped too. Now, once the session got going, mega cap leadership was instrumental in driving the market higher. The S&P 500, it tested last Friday's high at 4140 earlier on and found some resistance. If we look at the 15-minute chart here, I'll pull that up here real quick for you so you can see. One little button here to click to adjust this. And we'll open this up a little bit. Right here, it was early in the morning. We have right here, right there. We have this top. And then this morning, it held up right there just for maybe 45 minutes. And then it just took off and didn't look back until the last 15 minutes of the day. And then, of course, we see that big red candle selling into the close. And then there was just some little tiny buying the last few minutes of the market right around that 20-day moving average. So the blue line here is tough to see because it's the 5 EMA. It rides right along with the candles. But right now, it is under that. And that's the only little bearish context that I can find in this particular market right now. Not macro. There's a ton of bearish looking macro indicators right now. But just looking here at the 15-minute, that's a tough one right there. It's got to be above that 5 EMA for this market to continue. That is, of course, is a very short moving average, but it's also the most frequently tagged moving average out there. And of course, that makes sense. Okay, let's keep moving on here. Now, before the market broke above that area of last Friday's high. The intraday chart had the appearance of being supported by a relentless bid, as every little dip, and emphasis on the word little there, was quickly greeted with renewed buying interest. Now, the resilience in price action was its own supportive catalyst today, as it drew in sideline money, presumably on the fear of missing out of further gains. The FOMO was real. However, one thing to contradict the FOMO, trading volume, it wasn't particularly heavy. So the fear of missing out trade, it hasn't necessarily kicked into high gear yet. What you want to see for a rally to continue is higher and higher volume. All of that sidelined money coming back into the market. Now, if we look on the S&P 500, there's this red line here, and it lines up perfectly with the top that was created back here. You know, this area where we just chopped around for a little while back in June. I still believe we have to break this line right here for me to change my belief. But I believe we're just going to chop around and move sideways just like we did back in June, unless we break above that high. That is a very key level. Now, if we look at this week's weekly expected move on the S&P 500, the top end of it is 42.11. Now, the past 2 weeks in a row, the S&P 500 has broken above the top level of the weekly expected move. Now, the weekly expected move is correct. Let's see if I can get these numbers drawn here. We got that one going. Let's go for the second number, and we're halfway there building our snowman. Good, we got it. 68% of the time, the options market is correct, and the market will fall within the weekly expected moves. Now, it is extremely rare for 3 weeks in a row that the market falls outside of those weekly expected moves. So we haven't tagged the top of this yet. So I don't think this bull run here can continue this week. And that's why I've got so much pressure on this line here. And it's sitting right about 41.75. We're at 41.55 where we closed today. So 41.75 is the line we have to break in order for this market to keep rallying. Key level. Write it down. Put it on your chart. And speaking of your chart, if you're not charting, there's a link in the description for a free account to TradingView. It's where we do all of our charting here. Okay, 41.75. That is the key level that needs to be broken in order for this market to continue. Now, market breadth today also showed big bias towards advancing issues. The advanced decline line, it was roughly a percentage of 11 to 5 margin. And that was true for both the New York Stock Exchange and the NASDAQ. Now, let's talk about the Qs, the mega cap stocks, right? They did wonderful. The mega cap stocks proved to be a big support in today's market. The Vanguard Mega Cap Growth ETF, ticker symbol MGK, it closed up 2.7% versus the 1.6% gain in the S&P 500. And if we look at the Qs and the weekly expected moves and its own red line, you can see the past 3 trading sessions, it stuck to that line as resistance. It couldn't break through. And when it did, because actually I should take that back. It did break through. We have wicks breaking through, and it only closed above it just slightly on July the 29th. However, today it made it past that red line, and it closed above it. That is good for the Qs. Now, the weekly expected move, the top of that is 324.26. It's not quite there yet. And if we look at today's high did not make it there. 323.73 was today's absolute high, not quite cracking the weekly expected move on the upper end of that risk range. Now, if the Qs happen to break above the weekly expected move, again at 324.26, the next area is going to be up here where this red line is. And that's at about 330, my apologies, 330. That'll be the next area of resistance. And if it can break that, looking at the volume profile, there is a big dip right here. The Qs could run. If the Qs get above the weekly expected move for this week and break 330, $330 a share on the Qs, then it will be easy sailing. There's no resistance at all until it gets to about 342 to maybe up to 347, this area right here where we chopped around back in April. Whew. All right, that was a whole bunch there, but we've got more. Let me just clean this chart up just a little bit. I don't like to leave messy charts. Almost. One more click. There, we're done. Now, another supporting factor was falling oil prices. The EIA reported a surprising build in weekly oil inventories that stirred up worries about a demand slowdown driven by lower economic growth. Now, this caused a stronger reversal in price action for WTI crude oil. And let's look that up. Just type in US oil. That's the easiest thing to remember. You don't have to worry about any fancy ticker symbols. It'll take you directly to WTI crude oil. All right, let's fix this chart here real quick. Get a better view. Yeah, I know. I left this one messy. Like I said, I don't like to do. Okay, resistance line right here coming down like this. It broke above it a few days ago, but it is still using it as resistance. And that's good for those who want cheaper gas prices to fill up your vehicle, right? Today, WTI crude reached $96 a barrel. And it did that on reports that OPEC Plus agreed to a smaller production increase of only 100,000 barrels per day for September. Now, July and August, they did 600,000 barrels. So a big drop off there in supply. Is demand falling because the economy is contracting? And will that help oil to fall further? WTI crude futures, they fell 3.6% to $90 a barrel. It's up about $1 right now, even in the after hours. That is a key area, $90. And if we look back here, these 4 dashes that I have on just above my head here, I'll make a longer line here. This area is key. Let's call it a zone right here. There is a red line right here at $90 even. That is a very important area for oil. If oil breaks that, oil is falling. It's going to go boom, down, down, okay? But if it finds support here, then maybe it could find like a falling wedge pattern. It could break this resistance and head higher. That's why this $90 level is so key for oil. So keep your eye on that. If oil comes down, the market can continue to go up. All right, let's keep moving on. The S&P 500 sectors, let's talk about those right quick. And I'll clean this chart up later. I don't want to waste your time cleaning it up too much here. All right, when we look at the sectors, obviously because oil was down so much today, look at that. On the right-hand side over here, okay? Everything is green. All 11 S&P 500 sectors were green except for one. And there's a few subsectors in there as well. And of course, the dollar is in there too, towards the bottom. Oil was down. It was the clear big time loser, or I'm sorry, energy sector. the big time loser for today. Now, the energy sector was down 2.8%, round it up to 2.9% if you want to. And it was the lone negative sector today. While mega cap stocks pushed information technology up 2.7%, consumer discretionary up 2.5%, as well as communication services. We can round that up to 2.5% too. Those three were at the top of the leaderboard. Now, communication services, they could have been higher today, but they were held back by one top lagger, and that was Match Group. Ticker symbol is MTCH. It lost 17.6% after the company reported bad earnings. Okay, back to the energy sector here for just a moment. Weekly expected moves. The bottom range for the weekly expected move for the energy sector is 74.94. It closed below that. As a matter of fact, let me pull this up here so we can see exactly where it closed. 74.42. So a few pennies, but still it closed outside of that range. Now, 68% of the time, you're going to close by Friday within those weekly expected moves. So I'm not counting oil out yet. Remember, 90 was the bottom for oil. If it bounces off of there, energy is going to bounce right back in to its weekly expected move range. And let me take this. I forgot to take this out. There was a gap right here that was left open. And remember, all gaps get filled. Let me tap on that and get it out of there, because that gap was filled today when energy dropped 2.9%. All right, so it is just slightly, again, pennies out. And again, I expect it to get back in here, especially by Friday. All right, let's keep moving on with this. One more thing to point out too, on energy, it's going to have some resistance when it gets back in here. Let me get my Sharpie out here. Right here in this area, it's going to find resistance there. And on the volume profile, that's exactly where the biggest price volume is. And that's right around the 76 to a top of about $78. So a couple dollar span there. That'll be an area to watch, again, for resistance in the energy sector. Okay, let's move on to the Treasury market, because it had a different catalyst from the stock market today. It reacted to the stronger than expected data from the St. Louis Fed President Bullard, who's a 2022 FOMC voter, saying last night that he thinks the target range for the Fed funds rate should be 3.75 to 4% by the end of this year. Now, the Treasury yield off of this, let's go to that. US 02Y, that'll take you there. It rose 3 basis points today to settle at 3.1%. It is down slightly in the after hours. And again, that this line right here, right? This purple or black line, I can't tell now. My eyes are getting a little blurry on the screen. This is an area of resistance for the 2-year. That's a good thing, because that's keeping this inversion from deepening. It has resistance, keeping it from going much higher than what would be the top here. I got it at 3.06, and it's right there right now. And of course, it did close above that for today. Now, let's look at the 10-year US 10Y. And the reason we look at the 2 and the 10 is because they're important drivers for the market. A lot of times they move in opposite directions. The 10-year today, it rose 1 single basis point to 2.75%, and it's down fractionally in the after hours here. Now, for the 10-year, what's keeping this inversion from deepening much, much further is there has been support at this area. Now, it is a little bit under that line, and not everything technical-wise on a chart will line up perfectly for you. So my suggestion is to make zones, or to think of it as zones. So if we go back here, yeah, there was definitely support at that area. We could probably bring it down to here, and this would be the zone. And right now it is in that zone. So that's a good thing. As a matter of fact, I want to change this from, I don't want this being red because it's not bad. It's a good thing. It's support. It's keeping us from going into a deeper inversion. Okay, ahead of tomorrow's open, we've got a big, diverse group of companies reporting earnings that, of course, will affect the market. From Alibaba to ConocoPhillips, I forgot the name there, Crocs, Duke Energy, Eli Lilly, Fiverr, Kellogg, Lordstown Motors, Papa John's Pizza, Paramount Global, Penn State National Gaming. What else do we have? Restaurant Brands, SeaWorld Entertainment, Shake Shack, Wayfair, and Yeti Holdings. That is a big, diverse group. So what is that going to tell us? Well, that's going to tell us how the economy is doing. Is it in good shape or bad shape? When you have a big, diverse group like that and all the different sectors reporting earnings, that's a good reflection of how the economy is looking and what is the future looking like for the economy. Now, also tomorrow on the economic data side of things, we'll get the June trade balance. The expectation is negative 81.7 billion. The prior reading was negative 85.5 billion. I would love to see that get into the positive. We also get weekly initial jobless claims. The expectation is 260,000. We got 256,000 last time around. And then continuing claims. Those all come out at 8:30 a.m. Eastern. Looking at today's data, we got the weekly MBA mortgage application index. It was up 1.2%. Surprisingly, probably because the 10-year has been going down. That's why I left it on the screen here. When the 10-year goes down, then interest rates come down as well. When the 10-year goes up, interest rates go up. Because remember, banks borrow short-term but lend long-term. That's how they make their money. Last week, it was negative 1.8%. Now, the July IHS Market Services PMI, the final reading was 47.3%. The prior reading was 47% even. And June factory orders, it was at 2%. Now, the main takeaway from those numbers is that order activity increased in June for both durable and non-durable goods, providing another challenge to the notion that the U.S. economy is in a recession. Now, I know we're in a paper recession. Jobs are a big reason for why there's this debate about whether we're actually in a real recession or not. Now, JOLTS came out yesterday. It dipped below 11 million to 10 million plus jobs. Were some of those jobs taken off the market because companies are looking ahead at maybe a deeper recession instead of just a paper recession? That's a possibility, leaving those jobs unfilled. Okay, lastly, as far as data for today, we got the July ISM non-manufacturing index at 56.7. That was a bigger number than expected. And this is the services industry, right? All those employees that are taking care of yard work outside. I used to own a grounds maintenance company. I know all about that. That is the type of work that this tracks. Now, the key takeaway from this number is that business activity for the non-manufacturing sector, again, services industry, it accelerated in July. At the same time, there was a deceleration in the pace of price increases. Now, the acceleration in overall activity, however, does not fit the idea that the Federal Reserve is going to be quick and pivot to a rate cut cycle. You following me there? I had to throw it in there at the end. Okay, that's everything that I want to talk about today. I do thank you for joining me. I'm going to get to any questions you have right now. So if you have them, throw them in the chat and we'll go over them. If you could, please smash that like button, share this video with a friend. And if you like this perspective, you want more of it, including the weekly expected moves for all 11 S&P 500 sectors, subsectors like the semiconductor industry, and a few extra stocks within that. Of course, a ton of other things. Click the first link in the description and come join investors just like you and me. All right. Total put call ratio is 1.26. My theory is the market is going up to burn bears premium. Thoughts? You are at an absolute excellent idea there. And that's something that I mentioned at the beginning when we were talking about SoFi and its short squeeze. The market right now got overextended, right? Here's the S&P 500, the SPX. Actually, I'm going to go to the SPY. I haven't pulled the SPY up today. Let's look at the SPY. Weekly expected move, 403.8 on the bottom and 420.1 at the top. Your idea that with the put call ratio, with there being so many puts, if we look at the grander scheme of things here for the market, in 2022, I don't want 21. In 2022, the market has just been so bearish, especially lately as we got really, really deep. And the S&P 500 and the SPY here got into bearish territory, right? When price is moving down like this, along this line right here, making these lower lows. When price is moving down, what do people want to do? Their emotion tells them that, oh no, price is going down. Let's buy puts or let's find an ETF that we can use to short the market, like SPXS, that ticker symbol. The further the market goes down, the more people load up into that, right? And then we get this massive bounce in July. We get this first one right here, and people are like, okay, this is a bear market bounce. Nothing is different here. And then the market starts going down. What do? Buy more puts. They short the market. The market goes up. Oh, just another little rally here. We're going to fall again. And then the market falls again. And what do? The market goes down, so they buy more puts. They short the market. Now, the market is in a short squeeze itself, much like SoFi. Look at this move here. Let me zone in here on recently. This move here, going from here, I'm going to start right here, the 27th of July, up to today. I mean, there's 3 days in a row where it gapped up. Let me move that line. We have a gap up right here. We have a gap up right here and a small gap up right there. 3 days in a row, the SPY gapped up. That was a short squeeze. And then once we reach that peak over the past 2 days with the market kind of going back just a little bit, that gave the bears an opportunity to say, oh, we're at the top, we're at the end, this is over. So what do? They short the market even more, causing a big burst today. However, now that we're getting to key resistance areas here, I think this rally is over relatively soon. Okay? I don't want to sound too pessimistic because the best investor is a realist. They buy from the pessimists and they sell to the optimists. Being a realist is the best way to be in this market. That's how you make it. But again, this red line, this key resistance right here, the SPY hasn't broke it yet. Wick hasn't even got up there to break it yet. It's going to be tough. Look at the volume profile, how it just accelerates out as price continues to move up. And it reaches its peak all the way up here on the SPY at about 438. There's going to be a lot of resistance. The overall macro impression is not good. The economy is slowing down. The consumer is being weakened right now. That's my view. That's my theory on the market right now. So this rally that we have seen going back to the middle of June to today, a lot of it had to do with the market being overly pessimistic and shorting it. Now that those shorts are running out, slowly but surely, we're getting to steeper resistance. I think the market will slow down. I like I've said before, if the market can break a zone up here, starting with this line right here, and let's just use the SPY for this, 430 up to 440. If the market breaks above that line right there, that line in the sand there, I will change my theory on the market. But until then, there are too many similarities to what's happening right now in the market to what happened in the rally and the short squeeze back at the end of March. Too many similarities. And right now, we only have more bearish or more growth concerns, I should say, in the overall broader market, in the economy. A question to ask, with the earnings season we're going through right now, a lot of earnings being good, a lot of earnings forecasting the next quarter to also be good. Remember last quarter when Target came out and said, you know what? We're expecting a great next quarter. And then 2 weeks after their earnings, maybe not even that long, they had to come out and cut their guidance. And then I think they did it a second time a week later. How many companies are fooling themselves right now thinking, you know what? We're going to continue at this pace. And then they start getting into this quarter, a month into it, month and a half into it, halfway through, and then they realize, well, the sales just aren't there yet. We're losing. And they have to come out and they lower their guidance. What happens then? Is the market going to continue to rally? No. No, no, no. Look at Walmart just today. Actually, let me read the headline. I haven't read the story yet. What was the headline? Where do I have it? Walmart. Walmart is cutting hundreds of corporate jobs. People familiar with the matter say after warning of falling profits. Walmart is a massive company. And I like Walmart. WMT is the ticker symbol. I like Walmart and I follow Walmart not because I'm super excited about the stock, but because Walmart is a huge barometer for how the actual real economy is. Walmart is where everyday people go to shop. And if Walmart is seeing a cutback, then so is the economy. At least my theory on that. You may have your own, which is okay and perfectly good. Debate is healthy. So don't feel like you got to follow with everything that I say. You've got your brain, you've got your thoughts, you've got your opinions, and you've got your theory on the market too. Use what I say to add to your theory. Make it better. That's good for all of us. Why do you think AMD dropped after earnings? I thought they were pretty good. 67% earnings growth. Yeah, data center is huge for AMD. I think it was up over 83% for revenue. Gaming was a bit of a disappointment. I think it was up like 31 or so percent for revenue for AMD. But let's just go to AMD for a moment here. And actually, I want to pull this up too real quick. One thing about AMD. Now, let's see here. I believe just give me a quick second. It's loading. Hashtag get a real computer, Adam. Okay, it's almost there. Dude, come on. Let's go. Almost there. Okay, now let me just go and find it right quick. Let's go. Almost there. Almost. Okay, there we go. Well, I guess I didn't do as much as I thought I did. So I was basically just pulling up our Twitter account because we post a ton of stuff over there, mainly just news related. But I posted this earlier today about AMD. It slipped Wednesday after it issued weak Q3 guidance, but the larger semiconductor sector saw broader base gains, and it did. If we go and look at AMD, one thing, just technical wise, their guidance was lowered. Here we go. Forgetting the highlighter. Why did they lower their guidance? Because the economy is slowing down. That's why. Even though everything we do is chip related these days. Electric cars takes a lot of chips. AMD is a big one, right? It competes with Nvidia. Looking at the stock chart alone, we can see even though it was down 1.1% today and 0.25% in after hours, it is still holding above this key level here. Just technical wise here. This level, if Nvidia, I'm sorry, thinking about Nvidia, if AMD can successfully bounce off of this like it did today and continue moving, that would be a successful back test of this, what used to be resistance, then just support for like a day, then resistance again with this back test. And this is what you want to see. And this is like an interesting time to enter. When a stock breaks a key level like this, and then it comes back down and lands right on it and then bounces off of it, that's a type of setup you want to see. And that's something similar that we saw down here for the weekly expected move last week, where AMD broke out of it, came back to back test it, and then it ran up to resistance. Okay. Those are when you want to get into stocks, right? If you would have rode this out from $85, it went up to 84-ish. No, maybe a little higher than that. Close to 85. That's a nice little gain right there. Now, just technically. So tomorrow, it'll be important for AMD to hold that key level technically on the chart here. Now, the reason I believe that AMD went down, it had a decent earnings report, right? There was growth, right? We can't We can't say that there wasn't. There was. But earnings are backwards looking. The market is future looking, forward looking. That's why guidance, and whenever I'm looking at earnings, guidance has more weight to me than what their actual earnings do, because the market is forward looking. Another area that is key in an earnings report is cash flow. That's like the number one thing for me, cash flow. Does a company have it, and is it good? And then the second thing about that, where are they putting that cash flow to work if they have it, right? Are they issuing dividends with it? Are they doing buybacks with it? Are they doing it and reinvesting it into the company? Those are important questions to ask about that free cash flow. So that's a key area to look. The biggest reason why AMD fell is the economy is slowing. And when the economy is slowing, that means people are buying less computers, they're buying less smartphones. We'll see what Apple has to say. I know smartphones were up last quarter, but how's it going to be in the next couple of quarters if this recession does deepen? There won't be as many smartphones sold. There won't be as many laptops sold. And if you're not selling that technology, then there's no need to buy chips. And we have seen larger companies cut their orders with companies like AMD and Nvidia. So that's my thought process to why Nvidia earnings weren't that great to me, because of its guidance. And because my theory says that this paper recession we have right now is going to deepen the further we go. Third quarter, fourth quarter, Q1 of next year, Q2 of next year. So to answer your question, yes, earnings was good. Yes, there was growth. It's the guidance and the slowing economy together that, to me, doesn't look great. Now, let me just put up Nvidia here, NVDA, just right quick, just to look, to compare technically, right? It's nearly doing the identical thing here. Now, Nvidia is down in the after hours about 0.34%, so just a fraction of a percent there, but it has pulled back, and it's at a key area too. As a matter of fact, they're not identical, but I'm going to put AMD's chart over top of Nvidia's chart. Let's see here. Wow, it's a huge difference. Okay. Let me just do this right quick. Just bear with me for just a second. Okay. So the red and green candles are Nvidia. The orange line here is AMD. Now, Nvidia is a little bit bigger of a company. And if you look at the levels that they're at, over the past, let's see here, it's really about July 26th, AMD had really taken off compared to where Nvidia went. Now, I know not the same company. I'm just a little experiment here with the chart and just the chart using technicals alone here. AMD got way overextended compared to its peer, Nvidia. That's another reason why AMD is pulling back. Just a technical reason on the chart. Just to give a longer answer to your question. So that's another big reason there too. When stocks run up quickly And we saw the same thing happen right here in this area. AMD ran up faster and fell harder than Nvidia did. So just something to keep in mind here. You can do these comparisons on TradingView just by tapping the plus sign up here to the top left of the screen, and you can compare anything. Actually, something good to compare is the dollar, which is the DXY. I know this doesn't have anything to do with your question exactly. And then you just come up here, tap that circle with the plus, and put in SPX or put in the SPY. And right now, the dollar and the S&P 500 have had an inverse correlation. As the dollar is weakening, the S&P 500 from that same point has been zooming. So again, just something interesting here on TradingView. I just wanted to point out since we're using it. Okay, cool. Any other questions, or we can wrap this segment up for today here. Again, thank you very much for being here with me. I do greatly appreciate it. And just make sure to click that like button for me. That's really helpful for a small channel like this. Okay. I'll give you just another second here if you have another question. If not, that's cool. We're good till tomorrow. I'll be back after the market closes tomorrow to talk about what happened, why it happened, and try to talk about what's going to happen in the future. I do think that the rest of this week, the market's just going to chop around. We're going to have red days and green days, just like the same period back here, end of May, beginning of June timeframe, where we just chopped around, and it was a very tricky time to trade. Trading now, you have to be very tactical, okay? Just like the not financial advice for SoFi, right? If you were in that trade and you're in the short squeeze, take your cost basis off the table and then let the rest ride. And don't be afraid to take your profits. Do not be afraid to do that. Thoughts on solar stocks? They're extended right now. And I think I saw a little headline about the bill in Congress needing to be changed and updated. Maybe it was a different bill. Let's see. The Senate. Oh no, that's different. That's different breaking news. The Senate has overwhelmingly approved adding Finland and Sweden to NATO, a move that leaders said is key to U.S. security after Russia's invasion of Ukraine. That's interesting. Okay, let me pull up TAN. It's a solar ETF from Invesco. It's a good place to kind of judge most all solar stocks. I know individually, it's not good. Oh, I think Sunrun had earnings reports today, and I think it was actually pretty darn good. I'll pull that up here in just a minute. Let's get a kind of market view, and then I'll look at Sunrun real quick. That's a company that I like. Okay, what did I have here? I had from May 12th up to June 6th, a 41% increase in TAN, right? Okay, we can all see that. Let's now look at the low created here on July 15th. So for about 2 weeks to today, TAN is up. Let me line this up here as best I can right there. 24.39% in 17 days. That's impressive. And it actually went a little bit higher than that before it started to fall down. Now, one thing that I say quite frequently is that all gaps get filled. Look at the monster gap left right here, okay? If I were to say, is a market overextended? Yes. The solar industry technically here is overextended and it needs a healthy pullback. Look at that monster gap it made, okay? Plus, that gap was made on humongous volume. Huge volume. Highlighter here. If we look right here, this blue line here is average, right? Then we've got this humongous spike in volume down here. And that's obviously why we got the huge gap up. People piled in, and it all had to do with Congress, right? Congress passing a bill being, nicer to solar companies and alternative energy, and of course, EVs and so forth. The headline that I saw was something in the bill related to EVs, I think it was. Now, I really want to look it up. I don't know if it was was it the Inflation Reduction Bill? Where did I see it? Oh, I don't have it here in my notifications anymore. And I'm brain fogged here on what the bill was. It could have been the Inflation Reduction Bill. That's a possibility. But there was a senator saying that they wanted to change something in there, and that's what has caused the market to kind of get on shaky footing. Except for Sunrun, which we'll look in just a second. Like I said, I think they had good earnings. But this gap up, this major run here, the RSI for TAN is at a 70 and above. So it's right on the line of being overbought. It needs a pullback. It needs to come down and it needs to cool off a little bit. The MACD is just starting to roll over. That momentum, again, is starting to lose a little bit of steam. And of course, we've seen that it has pulled back. But and I will give you a big but here. No pun intended on that. There is this, I can't believe I said that. There is this area right here, right? Whenever you break previous highs, that's a good sign. And again, right here, it failed to break through it. But when we get to over here, if we line that up, it totally broke through that. That is a very positive sign technically on the chart, even though I believe the solar industry needs to pull back. It needs to cool off a little bit because it's overextended. Long term, I love it. There are several companies in it that I absolutely love. Enphase, I love. Generac, I love. Sunrun, I like. I think it's got an interesting business model. It's more like a subscription service with solar. So it's got an interesting business model. And then, of course, there's several others. If we look at the volume profile here, too, just to point out these technical things, we go boom, boom, and boom. That was a big area. A lot of trading happening within that area. It's now above that, right? The volume profile goes in. There's less appetite for buying, for selling at these levels. And that could be a magnet pulling this, the TAN ETF back down, maybe even to fill this gap or to maybe try to start to wedge here and build out a base at this level. That would be a cool technical development. But right now, it is so headline driven. I do think it needs to cool off. I do like it long term, and I do think it is at a very interesting technical point here on the chart. Okay, let me pull up Sunrun. Ticker symbol is RUN, RUN. let's see here. It is almost, yeah, up 3.8% in the after hours, down 1.5% during regular session. So, yeah, they must have posted pretty good earnings. Let's pull this up and look here. Well, yeah, they lost less money, at least here for EPS, a 52% surprise to the upside, 16.5% surprise to the upside on revenue. So that looks good. I haven't looked at its earnings report or anything. In the after hours, though, it is stuck. Even though it was up 3.8%, it is stuck right here at its 200-day moving average, and that thing has just been, coming down like this. So that's going to be a bit of a resistance area for Sunrun. And again, it lines up with the volume profile right there too. And these two previous highs. So I think the solar industry, short term, it's overbought, it's overextended. It needs to cool off and pull back, which we've started to see that. And it'll be headline driven for the next couple of months. Long term, I think the solar industry is wonderful, and I think you should own a part of it somewhere. If the very least, hop into an ETF, wait for it to cool off and pull back before doing so, though. Okay, that's my thoughts there on solar stocks. Cool. Well, if there's no other questions, we'll wrap it up. I do appreciate your time, your energy, being here with me, talking about this beautiful market, and sharing your questions and your thoughts. And yeah, I love you guys. Absolutely. Okay, so I'll wrap it up here. Thank you so much for being here with me today. I greatly appreciate it. Make sure to click the like button, share this video with a friend, and click the first link in the description to get more perspective. I think you'll like what we have to offer. So click the first link in the description. I'd love to see you there. And I'll be back tomorrow after the market closes to talk about it again. So thank you, and I'll see you later. Take care.